Assalamualaikum, good evening and welcome to this special report. I am Nurishazin Aiman and today we'll take a quick look at how COVID-19 affected Malaysia's economy, especially through a change in interest rate. Over the years, many diseases have spread across the world, but COVID-19 changed everything. Airports were empty, shops closed, and almost every part of life was affected. Some sectors like healthcare and online shopping grew, but most of the economy was badly hit. In Malaysia, many people lost jobs and business shut down. On March 18, 2020, the government started the Movement Control Order or MCO to stop the virus. But this also slowed the economy. To help, the government and Bank Negara Malaysia stepped in quickly. Their main tool, monetary policy, especially interest rate. They lowered the overnight policy rate or OPR to make borrowing cheaper. This helped business get loans, people spend money, and keep the economy running even during the lockdowns. In this short report, we'll take a look at how interest rates were changed, why they were lowered, and how those changes helped Malaysia recover from the crisis. Stay with us and we explain what really happened and what it means for the future. I'll pass this presentation to Shazian.
Thank you, Shazlin, for the interesting presentation. Now, let's move to the next subtopic, which is the historical trends in interest rate during the COVID-19. Hi, my name is Shazlin Binti Sabarian and my matrix number is 2025 505 295. Before the COVID-19 crisis, Malaysia's monetary policy was generally accommodative but stable. The overnight policy rate, OPR, set by the Bank Negara Malaysia, BNM, stood at 3% from 2014 to 2019, but was reduced to 2.75% in January 2020 due to the signs of slowing global and domestic growth. Inflation was relatively low and averaging around 1-2%, and wage growth remained modest. There was no immediate indication of aggressive monetary policy until the emergence of the COVID-19 pandemic. During the COVID-19 era, at the year of 2020 to 2021, the Bank Negara Malaysia has lowered the interest rate to support the economy and keep the financial system stable. The OPR was cut 4 times in 2020, bringing it from 2.75% in January to a record low of 1.75% by July 2020. These cuts were accompanied by a liquidity injection such as lowering the statutory reserve requirement or we call it as SRR by 100 basis points to 2%. It's releasing the 16 million ringgit into the banking system. Inflation remained low and even has turned negative with deflation of negative 1.4% in 2020. It was actually driven by the subdued demand and falling energy price. And lastly, during the post-COVID period, which is 2022 and 2025, which is now, with the recovery in motion and global inflationary pressure rising, BNM, Bank Negara Malaysia, has shifted to a tightening monetary stance. Beginning May 2020, Bank Negara Malaysia has raised the OPR from 1.275% to 2%, followed by subsequent hikes to 2.25% in July, 2.50% in September, and 2.75% in November. The OPR peaked at 3% in May 2023. In mid of 2025, it has facing a softer growth and manageable inflation. Bank Negara Malaysia pivoted to a more dovish stance, which is on 8 May 2025, the Bank Negara Malaysia held the OPR at 3% but cut the SRR from 2% to 1%, and on 9 July of 2025, it has reduced the OPR to 2.75%. As you can see, the graph here represented the OPR trend in Malaysia from the year of 2019, starting with the 3%, to the current year, which is 2035, that currently the OPR is at 2.75%. That's all from me. Now I would like to pass the presentation to Ainur Aizah to continue with the next subtopic. Assalamualaikum and thank you.
Thank you, Shazian, for that engaging presentation. I am Ainur Aizah and I will be taking us to the next subtopic, which is key stakeholders impacted and key events leading to the issue. Key stakeholders impacted for consumer, businesses and policymakers. For consumer, COVID-19 caused job losses and reduced income. According to Bank Negara Malaysia, BNM cut interest rate to record lows from 3% to 1.75%. Lower rates make borrowing loan mortgage much cheaper. Several retirees face lower returns on saving and fixed deposit. Many rely on government aid supported by low borrowing cost. For the businesses, SMEs face closure, low demand and cash flow issue. Easier access to cheap credit due to interest rate cuts. Some invested in digital tools, others lack creditworthiness. Credit help reduce layoff and avoid bankruptcy for some firms. For policymakers, BNM and government use low interest rate to stimulate economy. Cheaper borrowing help fund stimulus packages such as wage subsidies and moratoriums. Side effects such as inflation, asset price bubbles and low saving returns. Rates were later increased to control inflation in 2022. There are 4 key events leading to the issue. The first one is global lockdowns, Q1 until Q2 2020. Number 2 is market volatility and financial uncertainty. The third one is central bank announcement and emergency measures. And the last one is rising inflation and policy reversal. Global lockdown on Q1 until Q2 2020, lockdowns halted tourism, retail and manufacturing. BNM slashed interest rate to avoid economic collapse. Emphasized interest rates role in crisis response. For the market volatility and financial uncertainty, stock markets and investor confidence collapsed. Central banks injected liquidity and cut rates to restore stability. The third one is central bank announcement and emergency measures. According to Bank Negara Malaysia, BNM cut OPR 4 times from 3% to 1.75%. This move reassured public and supported financial markets. And the last one, rising inflation and policy reversal. On 2021 and 2022, economy reopened, demand surged but supply lagged. Inflation rose sharply, CPI increased in Malaysia. According to BNM began raising interest rate to cool inflation. That's all from me. Now I would like to pass the presentation to Farhana to continue with the next subtopic.
Thank you, Iza, for the interesting presentation. Let's move to the next subtopic, which is factor contributing to interest rate changes during COVID-19. The first factor is policy decision. During the pandemic, many countries faced sudden economic slowdowns. Central banks like Bank Negara Malaysia and the US Federal Reserve cut interest rates to make borrowing cheaper. This encouraged people and businesses to spend and invest. They also used a method called quantitative easing, which is buying government bonds to add more money into the financial system. At the same time, government gave financial help through cash aid and wage subsidies. As a whole, these monetary and fiscal policies helped support the economy during lockdowns. For example, Bank Negara Malaysia reduced its interest rate from 3.0% to 1.75%, which is the lowest in history. Next, factor that contribute to interest changes is market force. Market force like supply and demand affect interest rates and investor behavior. During COVID-19, Malaysia faced economic uncertainty. People spent less due to job concerns and movement restrictions, while investors shifted to safer assets like government bonds and gold. This high demand for bonds caused bond yields to fall. As a result, Bank Negara Malaysia kept interest rates low. With low inflation and weak spending, there was no pressure to raise rates. Many businesses were also hesitant to borrow, so banks lowered rates to encourage lending. For example, strong demand for Malaysian government securities pushed 10-year bond yields down from 3.3% in early 2020 to below 2.5% by mid-2020. This showed that markets expected rates to stay low, and Bank Negara Malaysia continued its support to keep money flowing and help businesses to survive. Lastly, the factor contributes to interest rate changes was global events. Global events like pandemics, wars, and energy crises can disrupt many countries at once. COVID-19 was a major global shock. Lockdowns hurt industries like tourism and retail, leading to job losses and lower spending. Supply chains were also disrupted, especially when China closed key factories, which can cause shortage and higher costs. In April 2020, oil price crashed as demand fell. Oil exporting countries like Malaysia lost revenue. Low inflation gave central banks room to cut interest rates. What made COVID-19 unique was that it hit almost every country at the same time. In response, governments and global institutions launched big stimulus package and lowered interest rates together to prevent a deeper crisis. That's all from me. Now I would like to pass the presentation to Hani to continue with the next subtopic. Thank you.
Assalamualaikum and thank you Hana for the informative and well-delivered presentation. I'm Hani and I will now present the next subtopic, evaluation of measures and recommendations. In periods of economic uncertainty, monetary policy plays a critical role in maintaining stability. In Malaysia, decisive measures were introduced to stabilize interest rates and financial markets. These include lowering the overnight policy rate (OPR), reducing the statutory reserve requirement (SRR), and implementing loan moratoriums. These steps successfully reduced borrowing costs, stimulated domestic spending and investment, and increased liquidity within the financial system, ultimately supporting the stability of the banking sector. However, it is important to note that the effectiveness of these measures was partially constrained. Prolonged lockdowns, declining consumer confidence, and uncertainties of financial aid limiting their full impact. This signals the need towards a more sustainable and inclusive monetary policy framework. One key recommendation is the implementation of targeted interest rate instruments, designed to channel affordable credit to high-impact sectors such as renewable energy, healthcare, and digital infrastructure, with support from government-backed financing programs. In addition, expanding the use of digital financial tools, including fintech platforms and central bank digital currency (CBDC), could significantly strengthen monetary transmission. These tools can promote greater financial inclusion and expand access to affordable credit. An often overlooked but powerful strategy lies in improving financial literacy. By leveraging mass media, we can promote financial education that empowers households and SMEs to manage finances better and develop stronger trust in the financial system. Monetary policy may seem technical, but its impact reaches all levels of society, from stabilizing the financial system to easing debt burdens and reinforcing public confidence. Its role is vital, especially during periods of crisis. As we look ahead, Malaysia's monetary policy must remain supportive yet cautious. Gradual normalization of interest rates will be essential to avoid overheating of the economy, ensuring growth that remains aligned with economic fundamentals. Let us not only address short-term recovery but also focus on building long-term economic resilience. That's all from me. I now hand over the presentation to Shazlin. Thank you.
Thank you, Hani, Atirah, and also everyone. As the end of this report, COVID-19 had a major impact on Malaysia's economy, but monetary policy helped ease the blow. Bank Negara Malaysia lowered interest rate and the reserve requirement to make borrowing cheaper and improve cash flow. This move supported household and small business, helping them survive job loss and business disruption, but keeping rates low too long risks like inflation and reduced saving. As the economy recovered, BNM began raising rates again. Looking ahead, Malaysia must adopt smarter, targeted policy to support key sectors and keep the economy stable. That's all for now. Thanks for watching and stay with us until the end. Assalamualaikum.